it tell a story about the depth of the market, the amount that investors are not necessarily playing? The fact it's being driven by algos, the fact there's a lot of stop losses out there. And so there's a lot of factors going in that means that actually, despite this, and this is telling the case beautifully, 0.06 of 1%. If I just showed you one stat today and said, look at the market, it's doing nothing, and you walked away, it wouldn't tell you a fraction of the story. It really wouldn't, would it? Plus, you've got the data side as well. We've got some interesting Treasury budget balance data out later on as well. That's not going to be a great figure anyway. Let us move on and have a look at individual sectors. Maybe this will start telling a little bit more of that story as well. I mean, again, everything looking pretty calm at the moment. Food and drink, technology down 0.2 of 1%. But I mean, technology, look at Nokia. Look, glacial move, down 1%. Didn't feel like that yesterday. It was violence. There was blood on the streets yesterday for long investors. But now the auto sector, this is a sector. I know that Patrick is just not getting involved at the moment because, I mean, if there is a bigger value trap out there, what is it? I mean, you've got companies like Renault and Peugeot trading on 6 times forward. What does the DAX trade? 14, 15, 16 times forward as well? So you're talking like almost a third of the big automaker biased index out there as well, and yet the disparity. I mean, look, let me give you an example. What have I got here? Where have they got? Over here they are. So you've got Peugeot, 0.24 of 1% higher. You've got Renault, 0.03 of 1% higher. So what? 0.27 of a percent difference today. Jeffrey, I actually shocked him earlier on. I shocked him because I said, what's the difference between Renault and Peugeot year to date? I mean, would you know, if just off the top of your head, would you know? I wouldn't know. I'd say, they probably mirrored each other. They probably moved within a couple of percentage points. No, they're 44% different in their performance year to date. That's staggering, isn't it? 44% year-to-date difference between Renault and Peugeot. What a pair. What a pair. Anyway, media points out. Have I made my point? I think I have, haven't I? There's a lot going underneath the surface is the point. Okay, let's have a look at individual bourses. There we go. That's them. Okay, let's move on. Let's take a look. Let's have a look at some individual stocks. Okay, what have we got? Okay, the director's given me 3 companies. We'll start with ABN InBev. It's cut its full-year guidance for core earnings, saying it will face additional headwinds in the fourth quarter. It comes as the world's largest beer maker posted third quarter core profit that missed expectations due to a decline in beer shipments into China and rising costs. Right, one of the 3 stocks he gave me was Barclays. Let's have a look at that one as well. Barclays has beat. Yeah, they're a percent higher, 167. I mean, this has been a volatile stock. But if I told you that despite the fact these are quite good numbers, I'll come to those in a moment, this stock trades at 0.49 price to book. Incredible, isn't it? 0.49 price to book. They had a respectable ROTE, they got a respectable leverage ratio, they got respectable NIMs, the profit was moving in the right direction, but they trade on 0.49. I'm not telling you that that's wrong, I'm just telling you what it is. Barclays beat third quarter profit estimates, boosted by its investment banking unit. I would actually say, do you know what? That's what the read is from Reuters and my own team having a look at it and that as well, and Dow and everyone else. But I think the UK performance, you look at the domestic UK performance, their return on tangible equity is still above 17%. That's extraordinary. Brexit Britain, we're supposed to be in crisis, aren't we? Anyway, the banking unit, the investment banking unit, posted a 67% rise in earnings. The British Bank reported a £1.4 billion charge linked to payment protection insurance scandal, PPI. That's closed now, by the way, as of August. The lender also warned that meeting its profit targets for next year will be tough. Jeff and I spoke to the CEO, Jez Staley, outlining the concerns facing the bank.
Whilst there are some headwinds, we had a reasonably good quarter, and obviously the profitability is quite acceptable. But recognize, even with Brexit, we're still in a pretty benign credit market for the UK. And we have a very high beta exposure to the UK economy and need to keep our eye on it. We have been quite prudent in our extension of unsecured consumer lending, but we like the profitability that we've been able to generate.
This next was like a look in Karen Cho's wardrobe. They're all there. Look at them. Look at them. Or Jeffrey Cutmores, maybe. Anyway, unrest in Hong Kong has taken a toll on retail sales in Chinese territory. But 2 luxury brands, Kering and Moncler, have managed to absorb the hit by making up for lost business in other parts of Asia. Gucci, which is Kering's jewel in the crown, picked up customers on China's mainland and South Korea, which contributed to a 10.7% jump in third quarter sales. Meanwhile, the Italian jacket maker Moncler beat revenue expectations for the period, overcoming a 40% sales decline, 40% sales decline in Hong Kong. Moving on, WPP has reported its first quarterly sales growth in over a year, thanks to new contracts with the likes of Mondelez and eBay. On an organic basis, the key number rose 0.7%, but the world's largest advertising group said it expects sales and operating margins for the full year, citing twists and turns ahead. The French rival Publicis cut its sales targets for the second time this year, just a few weeks ago, warning about falling demand by US clients. AB InBev has... okay, thank you. The director's telling me it's open. There you go, down 8.5%. It's cut its full-year guidance for core earnings, saying it will face additional headwinds in the fourth quarter. It comes as the world's largest beer maker. Oh, this sounds very familiar, this read. World's largest beer maker posted third quarter core profit that missed expectations. I'm sure I just read this 10 minutes ago. Oh, got it, lovely, okay. Just director's telling me we did do this, or the producer. Thank you, Jill. 8.6% low, there you go. The shares are down. It's all a bit repetitive, it's a bit groundhog today.
Yeah, the funniest thing is I can hear the other side of the conversation that's going into your head, and the audience can't, but you're talking as though they can.
It's only one voice in my head. You know, there are many, as you well know.
What's interesting about these numbers, and let's bring Daniel Morris in on this. Good morning, Daniel.
Good morning.
You were talking earlier around Amazon, about the reaction in the market to the reported earnings. And again, we're sort of seeing it this morning here. You know, the AB InBev was you didn't think it looked like a downside 8% kind of number. And again, we look at the WPP this morning, slightly better than the guidance, and the shares got a 5% bump right at the start of trading. So there's a lot of outsized movement based on these earnings at the moment. What, if anything, does that tell us about the market structure and positioning?
Well, I think it tells us we're quite sensitive now to the outlook for profits, because we know, or at least we came into this quarter expecting negative year-on-year earnings growth. And again, we knew that was in the consensus. But if you're looking for a market to rise, when at this point you've got at best flat with the surprises, you really need to see something that's going to tell you profit growth next year is going to be numbers you're used to, you know, at least high single digits, if not double digits. That would be great. But then if we get a signal from companies that they're not going to meet that, then I think that's what explains the outsized reaction in the markets. If everyone was doing 10%, okay, you missed a bit, that's fine. When you're doing 0, it's a bit more significant.
I also think it says what was reflected in the prices of some of these stocks. So people expected great things from Amazon. It traded at premium multiples. WPP was a contrarian play, basically. It had a lot of headwinds to it, and anything that wasn't as bad as people maybe were worried about is viewed as a surprise. And ABI InBev also priced very expensively. People were paying up for the safety that comes with the stable earnings and revenue growth, and when you miss on that, the investment thesis changes.
The stocks fees index debate for investors is quite interesting at the moment, because clearly what this tells us is there's a lot of opportunity in companies if you pick the right stocks at this point. I was in Frankfurt yesterday at the ECB, and I think what surprised me as I was stood there talking about these negative rates, about the need for QE, about the necessity to help save Germany from recession, was that we got a new high on the DAX for 2019, even as we were talking about the risks to downside here. Again, you know, let me ask you the question. Why is the DAX apparently so strong, even as the backdrop is negative mood music?
Well, I guess the justification would be what you've seen for equities in general so far this year, that what's driven markets higher has not been earnings. You know, that's the key concern. It's been falling interest rates, and it's been an increase in multiples, you know, partly going down to sentiment. And that's not a combination you can see going on indefinitely. Multiples can only go so far if you don't have the earnings to underpin it. And you're right, if you look at the PMIs that we have from Germany last year, particularly in the manufacturing sector, shockingly bad. Also, if you look at German sentiment, often or normally, the current condition survey lines up pretty well with the equity market, as you would expect, a fairly high positive correlation. Year to date, it's been more or less the opposite, that German equities have done well, even as domestic sentiment just gets worse and worse in Germany. And again, you imagine that isn't really sustainable. Which one of those is going to change? Do you think Germany is suddenly going to wake up tomorrow with a bright, happy smile on its face, or is it, on the other hand, possible that you see more weakness in German equities?
I've referred to your tweet a couple of times, and I think it was in your notes as well. Is the S&P at historic valuation highs? If so, should we be careful?
Yeah, it's on price to sales. It's really never been higher. It's trading at 2.2 times.
Never been higher.
So in 2000 it got to this level, and in September 2018 it got to this level, and it preceded a significant market sell-off last 2 times it got to this level. On EV to EBITDA, it's trading at 13.5 times. The only time it ever got there was, again, September last year and the tech bubble. On price to EBITDA, never been higher. It's far higher than it got to even in the tech bubble.
Are you aggressively shorting on the back of it, or do you think it can go higher even though it's never been higher?
So we're not aggressively shorting. We're selling call options on a lot of things right now, and we've not even done that in the last month as implied vol's fallen a lot. But a month ago we were selling a lot of out-of-the-money call options. We think market's capped the upside right now because it's going to grow in line with earnings and revenues. Multiple expansion, it's just you're already at unprecedented multiples on most measures we look at right now. So if you're betting on equities, you want to find companies that are going to grow earnings or trading below all-time high multiples. And we've been moving into Japan, which is an area which is lagged. We bought NTT Docomo. We're getting a 5.1% dividend yield in yen. Japan Post, 5% dividend yield in yen. So if you like the safe haven characteristics of yen and you don't want to pay the negative interest rates, we like some of these domestically orientated Japanese companies.
How do you feel about the valuation of the S&P?
Well, if you look on price to earnings, it's not quite as high as it is in some of the other measures, but it's still high. And so I think it's absolutely true. You've got to come up with a reasonable story to justify the multiples that you're at. It again goes back to the earnings growth. That's why I think this season is so important. And even more than the actual results we get for the quarter, it's the guidance that you get for next year. And that's where you've seen a lot of these reactions in the markets. With forward guidance that I think has really driven the stocks as opposed to necessarily the earnings this quarter. And that's it. We need to see the earnings support next year to put the multiples.
But the earnings in the tech, apart from, obviously we've been talking a lot about Amazon, but you look around the tech sector, the earnings actually have been very supportive, it seems to me, for pushing the S&P and the Nasdaq forward.
I think it depends. So one, semiconductors have been disastrous, but again, it's a story that we knew. If you exclude semiconductors and you look at the earnings, say, for NASDAQ, it's only up 9%, I think, for the tech sector, which for technology isn't really all that fantastic. I mean, we have such high expectations for tech. Single-digit earnings growth isn't really what people are looking for. So, yes, they're positive. Certainly some companies are doing much better, but kind of more broadly for tech, it hasn't been so strong. And I think this also will take us back to the implications of the trade war, the bans on companies out of China. That's really reshuffling what's happening within the sector, the winners and the losers here. And I think that's also what's playing to the performance at the index level.
Daniel, Patrick, we'll come back to you in a few moments' time. I think the producer wants to have another look at AB InBev. No, hang on, they've moved on. They've moved on to Renault. Okay, let's have a look at that then. Renault posted a drop in third quarter profit, group revenues, I should say, on weak production at its partners, Nissan and Daimler. Numbers also impacted by low demand for diesel engines in Europe. The French car maker, which issued a warning for both profit and revenue earlier this month, also lowered its full-year growth outlook in the global auto market. So, Lafarge, let's have a look at this one. It's backed its full-year guidance, but struck a less optimistic tone on its European and African businesses. Shares still at 1.7%, which means the three-month picture is flat as a pancake. Sales at the world's largest cement maker fell about 3% over the third quarter, just missing expectations. Eni, the Italian oil major, has posted a 44% fall in third quarter net profit in line with analyst estimates. The Italian oil major blamed, of course, a slump on the oil and gas prices. Eni also raised output in the last quarter to a record 1.89 million barrels per day equivalent, and said it expects to ramp up production in the fourth quarter. Jeffrey, you're just back from Frankfurt. Was it emotional? Was the big goodbye emotional?
There were tears. There was joy. There was every emotion you could imagine. And it was great that Annetta got the first question at the press conference, because quite often that's political. And Annetta had the first question at the press conference. So we're going to hear from Mario Draghi in just a few moments. Mario calling for more fiscal stimulus as he holds his final press conference as ECB president, where Annetta got the first question.
We just got back from a beautiful city break in Bath. Midweek is the perfect time to beat the crowds. Just an hour and a half by train from London. It was so relaxing. We headed straight for Bath Christmas Market. Oh, I can still smell the roasted chestnuts and mulled wine from the chalets. We dropped off our Christmas shopping at the hotel. Then it was off to be spellbound at the Theatre Royal Bath. There's so much to do in Bath. I'm already planning my next trip.
Discover the magic of Bath this Christmas. Plan ahead at visitbath.co.uk/Christmas.
I can find and fund my car, from a Mini to a Jaguar.
Feel good car buying from findandfundmycar.com is the place where you can find quality used cars from trusted dealers rated by you, and where you can fund your car with finance to fit your budget. It's feel good car buying all in one place.
Shouldn't be a carry on, choose findandfundmycar.com.
What if your email let you see a project's entire history and not just the messages sent to you? What if everyone else on your team could see it as well? Then it wouldn't be email at all. Move communication from inboxes to channels in Slack. Instead of seeing a partial set of messages about a project, everyone in Slack sees exactly the same thing and moves work forward faster. Slack. Choose a better way to work. Get started at slack.com.
With school runs costing as little as 2p per mile, the electric car is now the car. Search Go Ultra Low to find out more. Cost based on economy 7 and may vary.
People have always told me I can be a bit wary of modern things.
Very true.
So when Jane suggested selling the house with purple bricks, I weren't happy.
No, you weren't.
You see, I don't like technology. I don't like the internet. I don't like moving house. I don't like their adverts. I don't like purple.
Luckily, I don't listen to him, and our estate agent Emma were perfect. She gave us her actual mobile number. She was always available.
Fine, they were great. Still don't like purple.
Purple bricks. You'll be totally sold.
Fixed fee payable on instruction or after 10 months. Viewing services cost extra. See website for more details.
I tell you what used to be fair, lunch. You used to walk past pubs and just see people laughing and merriment. What happened to those cheery days? I tell you what happened to them. It's been replaced by a pint glass sitting by a computer full of condiments, plastic cutlery, and a pair of chopsticks you use for fishing the noodles out your keyboard. It's just not fair.
At TalkTalk, fairness is important. That's why, unlike some other providers, we offer fixed price plans on our fibre broadband for the entire length of your contract. Search TalkTalk Fibre. Fairer broadband for everyone.
Well, the world may be falling around us, but look at that. That's great, isn't it? Can we have a look at that view again? Just keep looking at it. It's beautiful. You've been to that restaurant at the top of that one on the... is it the Cheese Grater? Is that where the restaurant is? There's a couple of nice restaurants up there.
I don't think so.
No, is that just Karen?
I think it is.
Yeah.
Have you been?
No. See that one behind St Paul's? That's 20 Fenchurch Street. That's the walkie-talkie, yeah? I used to work in that building, with the old building that was on that. That was where I started in the city in 88.
When you had a proper job.
Let's move on. A change of heart. It was a tough career change. A change of heart from one of the key men behind Germany's famous debt break, Christian Kastrop, one of the former finance ministers, ministry officials behind tough fiscal rules that virtually banned Berlin from running a budget deficit, says Germany should raise billions of euros in debt to help fund new technologies, fight climate change and spur infrastructure investment. In an interview with the Financial Times, Kastrop argues that his government should create an investment agency to raise funds in capital markets and help modernise the country's economy, which is fascinating because we had a brilliant interview that Annetta conducted with Herr Schulz, the finance minister, which we ran extensively and did a load of chats about that while you were away, talking about that very issue. And Schulz was saying, no, we don't need to necessarily raise more money.
Well, it is the discussion du jour, isn't it? I think we'll take this back in a moment to Daniel, because I think it's fascinating. As the economy weakens, does this mean that the federal government is going to be more likely to unleash some fiscal stimulus? But let's just talk about Mr. Draghi first. The ECB president used his final press conference at the helm of the central bank to call on Eurozone countries to, quote, substantially boost spending to support growth. Responding to Annetta's first question at the press conference, Mr. Draghi said looser purse strings will help bolster the ECB's accommodative policy stance.
Regarding fiscal policies, the mildly expansionary euro area fiscal stance is currently providing some support to economic activity. In view of the weakening economic outlook and the continued prominence of downside risks, governments with fiscal space should act in an effective and timely manner.
Mr. Draghi also defended the European Central Bank's use of negative interest rates.
The overall assessment of negative rates is generally positive. For us, it's very positive. It's been a very positive experience. Negative rates have stimulated the economy, have affected positively employment, and so all in all, we're exactly in the direction we wanted them to be.
Mario Draghi explaining his position on interest rates. Daniel Morris is with us, senior investment strategist at BNP Paribas Asset Management. Daniel, as the German economy flirts with recession, does that increase the likelihood that we will get some fiscal stimulus?
Well, I think it's increasing the likelihood. We're just not at a point yet where they're really going to do it. And the concern is that eventually, if things get bad enough, then yes, the government will react, start to spend some money, which of course takes time to think about what you're going to do and by the time you spend it and so on. So I think the concern is we'll get there eventually, at least potentially, if things get bad enough. But at that point, arguably, it's too late just because of the inevitable delays when you look at fiscal stimulus.
The economy is screaming out for fiscal stimulus, so negative interest rates have done what they can do, and there's negative consequences to them now in terms of savers, in terms of pension deficits, in terms of basically zombie companies, and fiscal stimulus, much needed. We hear about the greatest economy ever in the United States from Trump's Twitter feed. If the Eurozone ran $1 trillion deficit, I think the Eurozone economy would be growing at 2%, which is what the U.S. is doing right now, because that's just a government spending with no multiplier would get you up to 2% growth. So 60% debt to GDP, running a small surplus in the time of a recession makes no sense when you've got a big current account surplus as well. It's screaming out for some fiscal stimulus.
What is the size of the deficit? Because we talk about this spending, and you know, Germany is a case in point, but we talk about the EU 27 as ready to splurge on fiscal. But correct me if I'm wrong, most of them splurged on fiscal before, during and after the financial crisis. Let's not kid ourselves that there's actually been real austerity. They've all been running, no, that's not true. Many of them have been running between 2 and 3% budget deficits for the entire period. Yeah, so this mythical splurge that's going to happen, it's been happening the whole time.
Well, it's going to happen from the north. So you've always had the south basically spending more than their means and running deficits, running large amounts of debt. But in aggregate, the Eurozone has a very healthy balance sheet. It's running very small deficit, and
but there is no aggregate. Why do we talk about this aggregate as if we had this crazy thing like a common fiscal policy, or a common currency and a common central? Oh no, we've got the latter, but we haven't got the former, and therein lies the issue.
But when Germany spends, it benefits the economies of the south as well. So instead of them just exporting to the south, if Germany does helicopter money and forces consumption vouchers, because if you just give money to people in Germany, they won't spend it. But if you say you've got to spend this consumption voucher, you can spend it on a trip to Spain, you can spend it on consumption, things like that. It may take helicopter consumption vouchers to get Germany to spend, but it's
parallel universe. Have you just jumped into that? On what planet are the Germans going to issue consumption vouchers to go and spend money in Marbella?
Well, I don't know if they will. That's what would get them to the greatest economy ever. I'm just doing the parallels to the United States, where I think most people say the U.S. economy is doing very well. It's just a completely different mindset in terms of fiscal spending, in terms of budget deficits, and the austerity has happened in the north of Europe. It's not happened in all of Europe, and the economy in the U.S. is a little bit smoke and mirrors, I think, whereas in Germany, it is screaming out for fiscal stimulus. I don't know if we'll get there.
If you talk to any German, tax avoidance is a national sport. I mean, quite frankly, they would like lower taxes in Germany, and perhaps that might lead to some further consumption activity. I mean, Axel Weber, who I spoke to at the IMF, was saying we need to see in Europe some replication of the Trump tax-cutting program, both for corporates and individuals. Do you think that would help boost aggregate demand, Daniel?
Yeah, I think it should. And if you need something. If the justification can be, say, around supporting climate change or investment in technologies to offset, it's kind of whatever it takes. I think the key thing is to spend some money. I mean, everyone's aware that the infrastructure in Germany certainly could be improved. So if just looking for a justification so that politically they can take that step, that's probably the key thing. I think on the offsetting side, though, we've got to remember if they did actually launch a big fiscal push, and certainly more broadly across Europe, that's likely to strengthen the euro, though. So what they're going to get with one hand can, they'll lose a bit on the currency. But at this point, really, it's the main weapon that they have left.
So as we wrap up with you this half hour, what is the appropriate mix of investments at this stage as we look at the balance between equities and bonds and then various geographies?
I think the lesson over the last 3 months is probably relevant, that even though we've had great year-to-date returns for equities over the last several months, it's been pretty flat. So at this point, you're kind of getting whatever carry you can on fixed income, and honestly, something a bit similar on equities. You're going to get your dividend income and then hopefully some price appreciation. So you still come out on a relative basis overweight equities and certainly overweight credit versus equities. But I think we need to have pretty modest expectations at this point unless we see some other trigger to really push the economy and the growth rate much higher.
You got a quick line on Brexit, given where we are?